how venture capital works. We're going to explore venture capital from its role in startups, some definitions and some terms, the process of venture capital, and what investors look for, as well as a few tips for you who are seeking funding and how you can make that a far less painful experience, hopefully. First up, my name is Dante St James, the expert in residence at the Darwin Innovation Hub, working with the Start NT cohort of clients that are working through from their very beginnings through the idea of investment and then exit as well. I'm also working with Charles Darwin University as a lecturer in entrepreneurship and design thinking and a certified lead trainer with Meta Australia and New Zealand. So, what is venture capital's role with startups? In what way does it play? What are the things you can expect from it? That's what we're going to explore right now, because venture capital is a form of private equity. So it's a share of a company and a type of financing that investors provide to startups and early stage companies that are believed to have long-term growth potential. And it often also involves fast growth potential, not just long-term, but fast growth as well in a lot of cases, particularly in the tech sector. Now, when we move on, we then start to realize that it's a bit more than just that. For example, a health tech startup might secure venture capital to do different things. They might want to fund some deeper research they can't afford on their own, or that might be to fund development of a prototype or a minimum viable product of what it is their product is supposed to be. They may even require that money is used to enter the market, to pay for marketing, to be able to produce mass-produced models of what it is they're trying to sell. So you can use that money for pretty much anything you like within the context of somehow further developing, scaling, or releasing your product or service. So how venture capital differs from other financial models, and we'll look at 4 different models here, is that venture capital is what we call equity-based funding. It's where the venture capital firm takes a small, usually a non-controlling stake in the startup, and they expect then to get some return at some point in that. So the equity base means that they will have an equivalent amount of those shares. It could be in the form of what is called a safe note, which then can be converted later on to actual shares in the company, or it could be something where, for instance, it's a convertible debt, so that they take on some of the debt, and that debt is then paid back to the venture capital firm, then with some additional interest in the form of equity in the company. As opposed to angel investors, who are typically high net worth individuals who produce capital for a startup, usually in exchange for a convertible debt, which I was just talking about, or equity as well. So they do a very, very similar thing, but they tend to be a lot less formalized, and a lot less organized, and a lot more impulsive, and investing in much smaller amounts than what venture capitalists tend to be, where venture capitalists can tend to be in the millions. Your angel investors tend to be in the hundreds of thousands generally. That can vary from capitalist to angel funder as well. Now, bank loan, which is what you might think of as a business would generally go, is just a regular kind of standard debt where you're paying it off over time. But instead of repaying with equity in a business, they don't take part of the business. You just repay banks with money and interest. So unlike venture capitalists, they don't have any interest in taking a piece of your company. They just want their money back with interest. Crowdfunding, on the other hand, is a bit more of a recent iteration on the idea of raising money for a startup, and it raises usually pretty small amounts of money. And when I say small, I'm not talking millions. I'm talking about maybe $100,000 to $150,000, and it's typically from quite a large number of people putting a small amount in, somewhere between that $5,000 to $10,000, maybe $15,000 per backer, and it's typically via online platforms. In Australia, we've got some like Swarmer. There is also Birchal, and several others. There's about 16 or 17 that are licensed to operate in Australia. We're not talking about necessarily crowdfunding in this way of, say, GoFundMe is. Very different kind of approach there. GoFundMe typically gives people back a product rather than equity in the business, where these crowdfunding platforms within Australia specifically are all about paying back in the form of equity in the business. So someone might put $5,000 in, and they may have 0.007% of the equity in that business, for example. So a startup may take any one of these, or maybe even take a series of these. More recently, I've seen some startups taking some crowdfunding to begin with to get their minimum viable product built. Then they'll take some money from an angel investor for a couple of $100,000 to then get that into a really market ready, ready to release product. And then they may take venture capital in the form of maybe $1.5 to $2 million in order to be able to then to scale that up. So it's not just one or two of these prototypes that are perfectly built, but it's now able to scale out with thousands or millions of these products going out to market. So you'll use different things at different stages, depending on what you need. Now, the role of venture capitalists, and we've got 4 different key areas where they perform in the life of the startup. And that's, first of all, starting with sourcing deals. We, as venture capitalists, proactively look for startups that fit our investment thesis. So here in the Paspalis Innovation Investment Fund specifically, we're looking for things that have some kind of connection or benefit to Northern Australia, particularly the Northern Territory of Australia. And we may be looking at other things like, for instance, some funds are just looking for financial technologies, fintech, or health or medical technologies, or they're really in resources and mining and resource extraction. Others are 100% in tech companies, and that's all they do. There are some more, like we are a very diversified portfolio. Our 4 current funds and our 2 upcoming funds are quite diverse, everything from robotics through to space, through to online commerce, to tourism, and even to things that are to do with AI. So there's lots of different things, and they're not always technology. Sometimes it's something which is just might seem quite mundane, like swimwear, for instance, that you might be investing in some way. We also, as venture capitalists, provide capital. That's infusing money into the startup business in exchange for a piece of that business, or a share in that company is pretty much what it is. Equity, whenever you hear that, just means some kind of stake in that company. Now, it's very rarely ever a controlling stake. VC firms don't tend to really want to go into that. They're not operations people. Excuse me. They want to work mostly in the area of just advising the operations of the company, but not having controlling interest in it. Mentorship and networking is also one of those things that comes with somebody who is a venture capitalist. So that person generally is very well connected. They tend to be very, very insightful and experienced at working with other startups. So they can offer insights into how the business needs to be guided along, as well as introductions to others who may come in. Now, maybe it could be other investors for the next round of investment. It could be clients that may be very useful. It could even be partners and strategic partners that it will help to be allies in their move into new markets. For instance, introducing them to, say, Austrade, who might be able to get them introduced to people in Singapore or Southeast Asia, where their market may be. Now, the governance side is one of those areas where a lot of startups being started often by 1 or 2 people don't often understand the role of a board. So what will happen is that the initial venture capitalist may take a seat on the startup's board of directors to help provide some strategy and oversight on how they make sure they do things right, in the way that you don't just let one particular person's personality override logic and the sensible way of starting and growing and scaling a business, but provide that guidance to help them to make better decisions, not based on emotions or hunches necessarily all the time, but upon really good information that's coming about. Now, there's some jargon, there's some terms, we've already had some in there, which would make people feel a little bit uncomfortable with approaching this world. So I want to demystify at least 4 of those. The first one being seed funding. I haven't really explained this one so far, but it's like a bit of initial money that's used to start a business. So seed capital tends to be smaller amounts that provide the opportunity to prove a concept or to build a working prototype of a model. Let's just say there's somebody who's wanting to build a water generation capsule that's going to be inserted into, I don't know, a local creek that's just going to generate a very small amount of energy, but they don't yet have that product. They've got the idea, they've done some research that says it'll be great, but they need some funding to build that first prototype. That's what seed funding may often be done. Now, seed funding generally sits in maybe the hundreds of thousands, not the millions, but it depends on how big the idea is. Some of the seed funding that came about in some very dodgy things like Theranos, for instance, which is was once a Silicon Valley darling, but is now a warning of VCs not really taking things seriously and just getting caught up in a buzz. that showed us that seed funding can be often in the tens of millions of dollars, hundreds of millions of dollars, with companies being valued in the billions. So it's just a little bit dangerous, but this is an area where there is an initial bit of money that's offered to get things started. So a game development studio, for instance, they may use seed funding to create a prototype of their game. So they've got a game they want to develop. They want to be able to have some kind of working model of it. It's not perfect. It's not the final product, but it's enough to attract the next round of funding, which we're starting to talk about: Series A, Series B, Series C, and there can be many. Go through the alphabet and get lots of them. I'm sure Uber and Facebook have all had lots of those series before they became profitable companies. So these are subsequent rounds of funding that help startups to go beyond that initial seed stage to reach particular milestones, being goals along the way. So goal number one would be to mass produce a product up to 100,000 units, and Series A may provide that. But now Series B is asking to provide the money that's going to pay for building a new factory somewhere that's going to produce 2 million copies of this particular product, so it can then go out to a lot more customers. That will be a new milestone, a new goal, and that'll be Series B. And then can go on to Series C, which might be now taking that particular product out to another country. So each series of funding will be attached to a particular milestone or goal that the venture capitalist is helping to support in that company. Now, bearing in mind that as each series comes, it's not always from the same venture capital firm. It's quite often not, in fact, from the same firm. So whoever comes in with seed funding may not be a big investor. They're not going to give you millions. They might just give you a couple of 100,000. They will have their share. And then the Series A will come along from another firm and they will get their share. So as you're working through that process as a founder, you've obviously got to balance all this money coming in with how much of your company you're giving away, particularly if this thing looks like it's really going to succeed. Next up, a fintech company might be wanting to secure a Series A round to expand to new regions, but their Series B funding round might be to diversify their product line, and Series C could be where they finally go out to the whole world. So that's a very good example of it, in fact. Equity, I've already explained, it's just an ownership stake in the company. It's often given in exchange for funding. So you come in with $1.5 million of funding, and that company, that startup, will give you a slice of that company based upon a valuation. So for instance, if they give you $1 million, and that's based upon a value of the company being $10 million, then they may own 10%. So they want a 10% stake at $1 million at a valuation that they believe in your company being worth $10 million. So a startup might give 20%, for instance, equity in exchange for a $2 million in funding, valuing the company at $10 million. So they'll break it up into a base where they say, we think you are worth this much. We want a percentage which represents the proportion of the investment we're going to put into there. Now, term sheets are basically your agreement that outlines all the basic terms and conditions of your investment. It itself is not a binding agreement. It's not a contract, but it's something where everyone agrees to the terms and conditions about how this thing's going to move forward. And then contracts will then be formed later, where there's we go into legals and all the contracts are drawn up and agreed to and signed. But a term sheet is pretty much, this is really what we're aiming for. This is what we're looking for. So when you hear that one, it's not a contract, it's non-binding, but it is an agreement to work together. A term sheet might say how much funding the amount is. It could be an equity percentage. So saying we want to give you $1 million for 20% of your company. It will outline what the rights are of the investment in the governance. They might have a seat on the board, or they might have a certain access to the research and development team you've got going. And it also lays out, other key terms that may be useful in defining how you're going to work together between investor and the original startup as well. So how does this all come together as a process? We've got a 5-step process here, which really outlines in most cases how venture capital works. Now, I'm not going into how venture capital funds are funded or how they come together. This is more about how you, as a potential investee, may work with a venture capital fund. Now, the first thing we do, we go out there scouting for new opportunities. We want to identify and secure investments before anyone else does. So we're often out there on the road, knocking on doors, having coffees, listening to referrals from people, taking pictures from people who come in the front door and say, hey, I've got an idea, in order to get those early opportunities, because the early bird catches the worm, right? So in venture capital, that's very much true as well. The earlier you are in the process, the more chance you have of being able to make this into some kind of success. Secondly, you have an opportunity to go beyond that into the due diligence and evaluation. Now we've identified a startup that we want to invest in. So therefore we now need to do an analysis of the market that you're trying to target. What is the total addressable market? What's the total achievable market, or the total obtainable market? What is the different research you've done with your market analysis? Is that real? Is that true? Is that reliable? Then we'll look at the financial scrutiny. What are your books like? Are you actually keeping control of all that spending, or are you spending in ridiculous things and ridiculous levels? Because the way you treated money before we came in is pretty much going to be the way we think you're going to treat money as we come in as well, unless we give you some special guidance in that to be able to put you along that journey. And then there's a team assessment where you look at all your different team members and how they work together, whether it's cohesive, whether it's a team which has a diversification of skills. And we'll, of course, look at the product itself. The product or the service you're going to offer, we need to know whether that is actually going to be something that has legs, actually got some potential. The negotiation and term sheet finalization stage is where we're talking about your valuation of the company. So founders tend to have one of two very different, very diverse ways of looking at the value of their company. Either they value it way too low and they say, oh, this might be worth $1 million, or they value it way too high and say, oh, no, this is worth $100 million. And these are people who generally don't have an idea of what the value of $1 million is and how hard $1 million can be to come about in many, many corners of the earth. There's many people who will never earn $1 million. They may get up to $100,000 a year for the next 4 years, but they may never actually make $1 million. So these are numbers that are not often achievable by someone in a work or a job capacity. So we'll have those discussions with you, talk about the terms of investment, how we're going to take a piece, what we're going to do, and then finalize that term sheet so everyone knows where they stand. Everyone understands what part they're going to play in this. And then there's the post-investment management, which is where in part of your team, we are participating with your board, and then we're adding value through bringing our network in to work with you, to introduce you, to give you more advice, to provide support for you. Because now that we're an investor, we really want you to succeed. So we're going to be in a place where we try to introduce you to people who will help that success come. And that may involve a little bit of operational guidance as well. If we feel like that your particular approach is not really working, you're hitting road bumps, we can help to provide some guidance and support and advice in that as well. And finally, we look at an exit strategy, which could be, now, as investors, particularly in the early stages, we don't necessarily want to be a part of your business forever. We really are there to make money, to get in and then get out with our pound of flesh, I suppose you could say, but it's more like to get out with our investment intact and then with some additional value as well. So just like a bank will come out of an arrangement with the principal paid off plus interest, we kind of have an interest of our own, which is more, the value of the shares we have in your company, that we may be able to sell those. Now, you could pay us off and buy us out through your own IPO, initial public offering, going public on the Australian Stock Exchange, for instance. If there is such a big enough thing that you've got going, then that could be a really realistic way of you doing it. But it could also be a merger and acquisition, which is a bigger company comes along, sees the idea, they want to acquire you and take your technology to make it part of their business as well. And that happens quite a lot. I think in the earlier days of Silicon Valley, we were all looking at Google swallowing up a lot of these small startups because they had great ideas, great technologies. And so they would just buy these little companies in order to merge in that team, merge in that expertise, and merge in that product. Secondary sales is where, for instance, we may get out because you've got another big investor coming in and they want to have their 49% stake, and they don't really want a small investor like us being in there as well. So we will sell off our stake to them, and that's how we'll make our money back as well. In the most unfortunate situations, you look at liquidation, where, for instance, if the startup doesn't work, all the assets that are gained, whether it's real estate, cars, equipment, intellectual property and all that, will be liquidated in a way to get the money back that was originally invested. So that's only in the most worst case scenarios where this startup just doesn't work at all. So what do venture capitalists look for? I've got 5 points in this one as well. First of all, they're looking for a solid founding team. You as the founder and the people around you are looking for dynamics, how you work together, how cohesive you are. Is your teamwork on point? Do you have a diverse skill set? For instance, someone may be the front person who is definitely the salesperson, talk to anyone and get them convinced to do things. Another one could be an operations person. They understand logistics and the way things fit together. You could have a technical person who knows how your technology works and help to build that technology. The idea is that you wouldn't have too much of any one of those areas. Now, there may be only 3 of you or 2 of you, but at least one of you has to have some kind of control the books to understand what the financials are. And that's what a really solid team looks like to a venture capitalist. Another thing is that we're looking for the market potential. How big is the potential size of the market for your product or service? Is it in the double digits or is it in the 6 digits? We're looking for how this thing could growth, how fast it could grow, what kind of growth we can expect. We're talking about scale here. So if it goes just beyond just being released within, say, the Darwin market and then being able to be evolved in the further market, it goes out to markets that go well beyond the borders of the Northern Territory and out into the wider Australia, Southeast Asia, Pacific, North America, into Europe, Africa, and China, or even India as a potential market that you could sell your product into. And then there's also the factor of market saturation. What's already out there that's doing this? And if they got a really good, like a pincer hold on that market, that it's actually very hard for you to move into it. That's also something that we're looking at. Venture capital is also looking at the uniqueness. What is the one thing that could possibly break through the barrier of going from being a great idea to a market success? And we look for things like, how innovative is this idea? Will this idea scale up to something far bigger and go beyond just a few test units and become a major product on the world market? And the aspects of this particular idea, can they be protected? Can you trademark something? Do you have the intellectual property of that particular thing? Do you own the technology? Did you invent it? Is there a patent that could be applied to it so that we can protect it around the world? Because the last thing you need is build a great little widget and then it goes to China and someone picks it up, reverse engineers it, and it's basically cuts your grass, releases it on Temu or Wish or Amazon or eBay before you've got a chance to even get established. So that uniqueness is a very important thing in how you are proposing to protect that uniqueness as well. Traction and metrics is all about whether the users of your product or the users of your services are actually using it. Are they actually finding use of it? And are they sticky? Are they coming back and using it again? That's where revenue and profitability come in. Are people willing to pay for the product? Because quite often great ideas are awesome when they're free, but the minute you put a dollar value on them, everybody runs away. And I think we saw this in areas like kind of like failed software areas like Evernote, for instance. Evernote just never really got past that paid barrier. Everybody was willing to use it in the early 2000s, but nobody wanted to pay for it. And so they made it harder and harder and harder for people to use it for free so that people would just give up and pay for it. But what happened? People didn't pay for it. They just went to free alternatives like Google Keep or OneNote that's part of the Outlook suite and the Microsoft 365 suite. So there's always, if there's a way out for people to get there, they will take it. Also, your ability to take customer feedback and understand how that instructs you on how to move forward. So that customer feedback, that user engagement, how into what you're doing is your users and your customers, that's the sort of stuff that venture capitalists look for as well as very importantly, where's the future roadmap? Where's this thing going? What are the long-term goals? What are the plans that we're putting in place to achieve little milestones along the way onto those long-term goals? And if it doesn't work in this current format, what is plan B? Now, a lot of people go, I haven't got a plan B, but you kind of need one because not every idea is going to work. So there has to be some kind of thing where you can take this basic idea you've run and turn it over to another plan in case things don't really happen. Got a few tips now. If you are the kind of person who's seeking venture capital funding, that might be really useful for you. First one is have a compelling pitch deck. It's a set of slides on PowerPoint or however you might use it. I particularly use Canva to do mine. That needs to be concise. It's not full of words. It's just basically prompt words that come with a discussion. They tell the story, not just of the product, but of the people behind the product, of the founder. People are fascinated by founders, and so are venture capitalists. They want to know not just whether they can believe in your product, whether they can believe in you as well. And this pitch deck should be attractive, not a hand-drawn piece of rubbish. Usually things don't get funded from a whiteboard drawing. They get funded because someone took the trouble to make this thing easy to understand. And also, you go, excuse me, that time of the day, almost ready for lunch, you've got to know your numbers. Have some mastery of how your money moves, your cash flow analysis, have profit and loss statements, have all those pieces of paper or spreadsheets or systems in place. You might use Xero, you might use MyOb, you might use any kind of QuickBooks, whatever you're going to use, or SAP if you want to go that far. You can have things that actually help you to measure how your business is going. You can see those growth metrics. You can see we need to grow to this point. This is how we're going to measure that success, and understanding your market better than anyone else. If a venture capitalist was to sit down to you and they'll ask you, so what's your market? And you go, people, they're immediately going to shut down because they realize that you don't have any idea who you're trying to sell your product or service to. So know those numbers, know how many of them there are, build relationships along the way. And then this is what the venture capitalists often do themselves. They are very big relationship people. They attend everything. They go to every networking event, so they can provide you as their client, as their co-investee, to warm introductions to people who can help you. So if you need an IP lawyer, they'll know one. If you need an accounting professional, they know one. If you need to speak to someone in the Chamber of Commerce, well, they know the CEO. They'll get you into that seat. And also having some kind of marketing now to yourself, being able to communicate through things like social media releases, being able to take interviews at the local radio station or even on podcasts. Those relationships are vital because they show early momentum and early excitement in whatever the product or service you happen to be releasing. And then naturally looking for some kind of traction or some kind of fit with the market, knowing that there's a proof of concept. You haven't just got this idea in your head, you've got it worked out at least on paper, and maybe even into a hi-fi mock-up, which basically means a working mock-up, or even a lo-fi mock-up that clearly shows how that thing could work. And looking at what the growth indicators are, can we see that there's already indicators of growth in this early stage? Can we see that your numbers of your customers or your numbers of your users are growing quite quickly? And getting some customer testimonials from those people who use it that shows, yes, this is a great market fit for the market you're trying to reach with your product or service. And this is a hard one. Be prepared for hard questions, because when you sit in front of a venture capitalist, they'll want to know that you've done your homework. You'll have answers that are confident, clear, and concise to every question they ask. The key to that is to be absolutely transparent. The minute that any VC feels like you're hiding something, they will step away from the conversation. The enemy of trust is hiding figures. They don't necessarily care whether the figures aren't great. They just need to hear what the figures are so they understand what the problems are and how they can help, not just with money, but with expertise as well. And then finally, learn from the feedback that a VC gives you. If they don't take you on, listen to the feedback they'll give you as to why they won't take you on. They'll give you very honest feedback and tell you exactly the things you need to work on. The chances are if one VC rejects you for these reasons, any other might do as well. So when you sit in front of someone the next time, have those problems addressed, or at least say, hey, we talked to X people and they told us Y problems.